Hello, everyone. Welcome back for another Fratarcangeli Friday Market Update. A day early on Thursday due to my travels tomorrow. I'm excited to report to you that we're 75% or 3/4 of the way through of earnings season for Q4 25, and the numbers have been strong. We're in our 10th consecutive quarter of growth, and we're looking at double-digit earnings growth, which is strong and consistent for what we've seen recently. Also, 75% of the companies have beat both top and bottom line. This is continuing to be the case as we've watched for the last several years. And it's a very robust earning expansion that, having been in this position for 3 decades, I can tell you that I haven't seen anything quite this strong. I think the only comparable could be coming out of the financial collapse in 2010, 11, and 12. And then, of course, going back to the, call it .com and internet bubble in the early 2000s and late 90s, that I can align to this. And this is even greater. So earnings growth is something we're watching closely. But I will tell you, the tech sector, and specifically AI, continues to have high demand, but we're seeing a consolidation since October. Some of the concerns about high valuations. I believe this is very healthy as we retest and look at and re-question which companies are going to thrive and how this is going to change the landscape, and will they be able to continue this expansion in earnings relative to tech and specifically AI. I can tell you, having lived through the bubble of the late 90s, this is something I welcome, as I think it'll help us position ourselves for that next breakout with real sound, specific data to support a continued expansion. What we're seeing simultaneously is a rotation. We're seeing industrials, manufacturing, healthcare, financials, and even defense start to see some movement in the market upside that we really didn't see last year or the year before to the level that we're seeing today. Another area that's promising is small and mid-cap stocks. What has this taught us? Do not chase the areas that are necessarily thriving for a continued, call it time frame, like AI and tech have. Have a diversified portfolio. Make sure you're balanced between growth and the disruptors and the expansive, call it momentum stocks, and then maintain those levels that we have in the other areas of the market that will eventually be the benefactors to this breakout in technology on the value side. Make sure we diversify. Make sure we look at the long-term picture and don't get caught up in being the last one to the table, if you will. I will say this. I do not think that the tech trade, I do not think that the AI trade is done, based on what I've seen historically at the end of an expansion. At the same time, you need to be diversified. You need to look at what your objectives are, what your time horizon is. Can you adhere to the volatility to the level that certain categories will bring, and make sure you build a portfolio that's sound and can overcome any environment. In addition to that, the Fed came out recently and did not touch rates. Rates stayed the same between 3.5 and 3.75% on the Fed fund rate, which is the short-term rate, which is, of course, down substantially from its peak. I also believe the consensus will become real, and that later this year in the summer or the later months, we probably will see a rate reduction. We'll keep a close eye on that, but we're very focused on the data. The data is very interesting. We're seeing right now job reports coming out recently at 130,000 new jobs created, and the consensus anticipated was 55,000. That's a big, big gap there. And we see that as being very strong. But of course, the Fed's watching that detail as well. We're also seeing some really strong manufacturing numbers come out. It's almost like the Goldilocks scenario. We're getting strong productivity, but we're seeing inflation somewhat more tamed. That's the perfect scenario, and the perfect scenario for a strong economy domestically and globally that I think is building stronger and stronger every day as we look at the data. We're also looking for GDP, gross domestic productivity, which is a clear, concise data point that we monitor relative to productivity. We came off of a 4.4% GDP number in Q3. We're expecting the same in the fourth quarter numbers that'll be reported tomorrow morning at 8:30. We'll be watching that very closely, and I know that the market is hanging on to those data points to see, one, is the economy continuing to expand? Two, how does inflation relate to that? And then ultimately, where are we at in the Fed cycle? So I would say the takeaway and the call to action is make sure, once again, we have enough liquidity. Make sure that your long-term money's put to work in an appropriate fashion. And remember from our last conversation, the second year of a first-term presidency, which is what this is touted for, is historically the most volatile and least rewarding of all four. But what's interesting on the heels of that is the third year, which usually starts to really pick up steam after the election and the midterms this November. We start to see the most promising and the most rewarding performance in the market. So we're building brick by brick a strong foundation portfolio to be a part of that next expansion. I do not believe this expansion is done. I believe we're in a secular bull market that'll have pullbacks and retrenching along the path, which is healthy, and we'll be breaking to ultimately new highs in the coming year, if not years. I look forward to talking to you all in person. Be safe, and I'll see you soon.